Hi, my name is Doug Goldstein. I am the Director of Profile Investment Services. I'm a certified financial planner and an investment advisor. I specialize in cross-border clients, mostly people who are Americans or who want to have U.S. brokerage accounts, but who live outside the United States. Today, we'll be talking about how to increase your retirement income. For those of you who are nearing retirement or who are already retired, probably you realize that with interest rates where they are today, it's very difficult to simply put your money in the bank, live on the interest, unless, of course, you have millions or tens of millions of dollars. But for regular people, there are a few things that they can do in order to try to increase their retirement income. Please remember that we're going to be discussing a number of different investments and investment ideas, but this is a general discussion, and you should absolutely speak to your own investment advisor before investing any money. So we're going to talk about the importance of having a customized solution which combines both financial planning as well as investment services. Financial planning is often compared to the blueprints that someone draws before building a house, because obviously you need to have a plan before you actually do anything. And the investment services is the nuts and bolts. Once you know basically what direction you're going in, what stocks or bonds or mutual funds or money managers do you want to work with, those are the specific investments. So it's important to get personal advice, because there's no such thing as one idea fits everyone, and of course you want to get it from someone who's knowledgeable. So today we're going to talk about reviewing what your long-term goals and needs really are. Is it possible to increase your retirement income? A lot of people ask me that, and one of the things that I found when I sit with clients is they'll show me that they've got a lot of money in short-term CDs, those are bank deposits that they've been rolling over year after year, and what happens when you do that is you pretty much guarantee yourself to get the lowest possible yield on your money. Of course, it is very safe. Bank deposits are insured by the FDIC for up to $250,000 per investor in an account. And if you are not a U.S. citizen, you can still benefit from the FDIC insurance if you have your money in an FDIC-insured bank account, or if your broker buys you FDIC-insured CDs. The normal sources of income that people have will be pensions, or they'll get American Social Security, or depending what country they live in, they will get a local government pension. A lot of times people worked out an arrangement with an insurance company known as an annuity, which is basically you give the insurance company a chunk of money, and every month they pay you it feels like a pension. They're paying you a payment every month until you die. There are pros and cons to that. In fact, there are pros and cons to everything here. And of course, you may have salary. When you retire, a lot of people retire from their main job, but continue doing some sort of ongoing work. The investments that a lot of retirees are looking to now in order to increase their income can generally be divided into two categories. There are bonds and stocks. Bonds are traditionally what retirees use because they tend to be more conservative than stocks. But the fact that they tend to be more conservative does not mean that they can't lose money, because sometimes bonds and bond funds do lose money. But as a general rule, you can assume that they will be a little safer than owning stocks. You also have to ask yourself a question, is whether you feel you can handle the investments all on your own. So let's break this down a little bit. Let's say that you want to own bonds. What is a bond? A bond is simply a loan to a government or a company. You lend them money, and you will receive interest normally every 6 months, and then at the end of a specific period, you will get back your principal. So for example, if you were to buy a $100,000 5% bond, you would pay $100,000. You would get $5,000 every year. Usually that would be $2,500 every 6 months. And then let's say it's a 5-year bond. At the end of the 5 years, the government or company to whom you lent the money will give you back your principal. Of course, this presumes that they don't default, that they're still in business. And the other thing you have to realize is that during the life of the bond, the value of the bond might go up and down. So the fact that you put in $100,000 today does not at all mean that every day you will see $100,000 written on your statements, or if you go online and look at the value of your account. The deal is that at the end it's worth $100,000. So there really is volatility in a bond portfolio, but if you own the individual bond, you know that at maturity you'll get back your money. So a lot of people don't want to pick and choose individual bonds. So either they will work with an investment advisor who will help them do that, or they might choose to buy a bond mutual fund. A mutual fund is basically a basket, and everyone puts his money in, and the managers buy and sell whatever type of security they're supposed to be buying and selling. So if you own a bond mutual fund, you can expect the bond managers to be buying bonds. The benefit, of course, is that you get professional management. This is what they do all day, every day. One of the problems is that because you don't own the individual bonds, which have a maturity date in and of themselves, you have no specific date when you know you will get the money back. Bond funds don't have a maturity date. They're perpetual. Another benefit of using a bond fund is that the managers, because they're usually buying in much bigger quantities than you would buy, is they will get a better price if they're buying $1 million of a specific bond compared to you might be buying a $10,000 bond. They can negotiate better deals. And of course, because they're dealing with a bigger pool of money, they can diversify better than an individual normally can. And another benefit is because they own so many different bonds, oftentimes you will get monthly income instead of having to wait for the semi-annual income payments. Then there's stocks. Some people buy stocks that pay dividends. Traditionally, you'll find companies in the utility industry or REITs, real estate investment trusts. These are companies which buy stocks. Which buy actual real estate, and they manage it, and they collect the rent, and then you get some of that passing through to you. Or people like to buy oil and gas pipelines, the types of industries that have a lot of cash flow. So there's a lot of possibilities in buying individual stocks that pay high dividends. Of course, you may find that you don't want to pick and choose the stocks, in which case you might once again go for a mutual fund or an ETF, an exchange-traded fund, which works very much like a mutual fund. There are differences, but an ETF, because it trades on an exchange, you can buy and sell it all the time when the stock market is open, compared to the normal mutual funds you would buy, which normally only trade once a day. And again, with these types of investments, you can get monthly income compared to a stock. When you own the individual stock, normally it only pays quarterly, and you get a lot more diversification, which of course does not guarantee anything. It doesn't guarantee your principal, but it's certainly a good investment principle to spread out the risk. If you don't want to handle all of the decisions on your own, then of course you need to work with an investment advisor who will advise you, but ultimately you're the one who has to pull the trigger. You've got to make a decision about whether you want to actually buy something that your investment advisor has advised you. The other option is to work with a money manager. Money managers handle all of the day-to-day operations. You, of course, have to decide on the big picture. You might say, I've got $500,000 and I want to put $200,000 in stocks and $300,000 in bonds, and you can assign those pieces of your portfolio to different money managers. The important thing you have to do is to hire a financial planner to make a really solid financial plan that reflects who you are. It's customized for you, and it'll cover your cash flow. It'll look at your cash flow from today through your retirement all the way up until the very end to look at the inheritance that you hope to leave one day. And then your financial planner or investment advisor can help you to choose a money manager who will handle the account. Now, once again, I just want to repeat what I said in the beginning, which is we've discussed a lot of different investment types: stocks, bonds, mutual funds, exchange-traded funds. Each of these has real risks to your principal, so you need to understand that. This has been a general discussion, and I hope it's helped. Of course, if you have any questions or you want to go over your own portfolio, please feel free to be in touch with me. You can go directly to the Profile website at www.profile-financial.com. Again, my name is Douglas Goldstein. I am a certified financial planner and an international investment advisor, and I'd be happy to help you out.